All right, incubator students, we're in the final run here. This week, you're going to put together your slide deck for your final pitch next week. So next week, I will be sending you times when you're going to present. Right now, I'm just finalizing the judges for the academic pitch. From the academic pitch then of next week, we'll pick a few finalists to go on for formal pitch competition. I'm looking at maybe probably around 3 groups or so, and we'll kind of see how it looks, and we'll piece that together. All right, so if you click on the rubric and you open the rubric up, this is right now I'm in the daily calendar document, and you open up the rubric, it has kind of how you're going to be evaluated for your final pitch. So when you put together your final pitch slide deck, you want to go in order on how the slides look here. Now, that doesn't mean you're going to have exactly 20 slides. You might have more. So for example, when you get to how you're going to get, keep, and grow, like I have it as kind of the 12th slide. You might have 3-4 slides on marketing. So you might have a bunch of slides for MVP test setup and results. So this is just the order of the flow of the presentation, not necessarily corresponding slides. So if you're treating this like a checkbox, you're not going to have a very dynamic presentation. This is the structure that you follow, the order in which it flows. But then within each one of these numbers, you're going to kind of get creative and kind of expand. So when we get to slides 14 through 19, these are the slides I'm going to walk you through. All of these up here you already have done. You've done it throughout the year. You set up. And even 14, 15, and 16 you've kind of did in your last year back. You just need to make sure, though, that now the numbers tell the story, and that story works its way into the financial model. All right. So what you want to do is you want to go back to the incubator in Schoology into your folder, and the cost of goods startup SG&A, you want to review this one again. So I'm going to pull this one up now. So as I open it up, I'm going to kind of preview it and show it to you here. So this is going over your 3 cost buckets. So when you make your slides, you're going to have your 3 different types of costs there. And I think the first one I have in the slide deck order is startup costs. So the startup cost is a one-time occurring cost to set up your business. And so here are the different examples that are in this presentation. It's important that you include that startup inventory number. And my recommendation is that you do inventory about 3 months out from when you need it. Because when you put an inventory order in, it generally takes some time to get that inventory. So we want to put the startup inventory dollar amount in as part of our startup costs. So let's say our total startup cost, I'm just going to throw a number out there. Let's just say it's $5,000. So in your slide deck, you're going to talk about what your startup costs are and then your total dollar amount and what is needed. And that's going to work its way into the financial model. Once you do startup costs, then you're going to do your SG&A. So your SG&A is ongoing. These are your ongoing costs to keep your business running. These are selling costs, maintenance of websites. If you have any salaries, marketing, ongoing marketing is probably going to be a major one for most of the teams. Any type of administrative costs. So these costs are going to be ongoing throughout the entire time period. Then the last one you're going to have is your cost of goods sold. So cost of goods sold, if you're selling a product, what is the cost at which you're buying the product for, and then that's going to work its way into that part of the slide. And what you want to do, though, is you want to make sure that you're you explain that very well and what that number is. So when you look at cost of goods sold, you're looking at the cost at which you had to provide something. So if, let's say I'm selling picture frames, and I acquire the picture frames from a supplier in, let's say, China, and they're going to charge me $3 per picture frame, that's my cost of goods sold. All right? So don't get that confused with your selling price. So once you have those 3 numbers, you're going to take those 3 numbers. So let's just say simplicity, my startup cost is $5,000, my SG&A is $3,000, and my cost of goods sold is, let's say, $5 a unit. So now I'm going to take that information. Once I have that information, I'm going to go back to my slideshow, my slide deck, and I'm going to make the slides for that particular part. So as I get through MVP results, I'm going to talk about my marketing. And part of the marketing that I'm going to do to get, keep, and grow, that marketing piece is going to appear in your SG&A cost. So this is how I'm marketing. This is what we're going to do. And then the dollar amount is going to appear here. So that's going to, so slide part 15 is going to validate what you came up with for part 12. All right, so 13 is where you're going to sell your product or service. 14 is the startup costs. 15 is SG&A. 16 is cost of goods sold. So once you have those numbers, you're going to run then into the financial model. So the financial model is also in your incubator folder. So here's the financial summary. And a lot of you guys have this already in your folder, your team folder. And so as I kind of explain this out to the, in my final pitch, I'm going to first focus on the units sold per month for the first 12 months. And then what I'm going to do then is I'm going to take my selling price per unit and multiply it by units, and that's going to give me my total revenue number. So really that is all based off of what you come up with as far as units. But your units have to correspond with your marketing. So let's say you're not doing heavy marketing right away, and then all of a sudden month 4 you're injecting tons of marketing in. Your units sold should then potentially go up. Maybe month 10 you're going into a big retail store. Your units sold should then jump and go up. So tell the story. Numbers tell the story. So if you're going to be a business major, we take accounting and finance, and we understand numbers, and the numbers tell what decisions the business are making. All right, so now once you have the total revenue in, you're going to do your total expenses. And what's going to be different here, we're going to put the, let's say I had a $5,000 startup cost and $3,000 a month for SG&A. Well, right away, I could plug in my $8,000 here, because that's a combination of my startup costs. And remember, the startup costs include the initial inventory run. And then I have $3,000 a month ongoing SG&A. So that $3,000 then carries out in the rest of the model. All right, just ignore all the numbers that are changing down here. So what I want to do with cost of goods sold, we're going to do what's called cash basis accounting. So we're only going to record the expense when we pay for it. And so we're going to run our inventory out 3 months. And so let's say our initial inventory run here, it looks like we have 35, 30, and 25. So that's 65, 70, 90. And remember, these numbers are low. We're going to have more than 90 units sold. Otherwise, we probably don't have a legitimate business. But let's just kind of change some of these numbers up. Let's say we were selling 200 in the first month, 250 in the second month, and 300 out in month 3. And so what we want to do is we're going to run our inventory out 3 months in advance. So if we have 300, 200, and 250, we have 750 units sold. So if we have 750 units sold, all right, I'm going to pull up the calculator here. Give me a second. So if I have 750 units for the first 3 months and I multiply it by $5, let's say my cost of goods sold is $5 per unit. When I multiply that out, I get 3,750. So what I want to do here is I put in my startup and my SG&A in the model. Now what I'm going to do at this point is I'm going to add my inventory runs. So that 3,750 is going to occur here, but we put that already in our startup cost figure, so we don't have to do that here. So that was part of our 8,000. The 5,000 startup cost, 3,750 was the initial inventory run. So now when we go over here, let me just put some units in here. Let's say we got 2, 3, and 4. So it's a total of 900 units. What we want to do then is we want to go back into the calculator. We got 900 units, and we're going to multiply it by 5, and we get 4,500. So we're going to run that inventory run 3 months out, and so that is going to occur right here. So I need to put the inventory run in here, and then I get the inventory for the next 3 months. So that dollar amount is going to get plugged in there. So the 4,500 plus 3,000 is 7,500. So the 7,500 is going to go here. Okay, and so every 3 months you're gonna see a jump in the numbers because of that inventory run. Okay, so that is what we're doing on the financial model, and that's how you need to break it up. And my next part now, I'm going to kind of reset this. All right, so all that has been kind of review. I've taught you all that before. That's just kind of a recap of how to fill out that model. So what you want to do now is, once you get that financial model for year 1, you want to kind of highlight kind of your final numbers. Then you're going to highlight, so one slide with the first year highlighted out, and then the next slide is going to have the 3-year summary. So the 3-year summary, you're going to kind of highlight this piece. So you're going to come up with a percentage change growth from year 2 to 3. To be honest, for a growth company, for a new company, the percentages in here I think are kind of low, and all these numbers are low. The reason why we're using low numbers is just so you could see how the financial model works. It's always funny for me is that people take the model and they manipulate these numbers a little bit and think that they're doing it right, but really these numbers are, if this was an actual business, we wouldn't even put any thought in because these numbers are just so low. All right, so once I though get my 3 years out and I have my 3-year summary, now I need to come up with my valuation. So the valuation is kind of here at the bottom of the page. It's cutting off a little bit, but it says pre-money valuation. It says $17,981. So the way we're going to get the pre-money valuation, this is to see the value of your company, what it's actually worth. You take the net income. So if I go up here and I get my 3-year total on what I'm doing here, so my 3-year profit, all right, so on my spreadsheet, my profit is this row here. It's 3,596. So if I take 3,596 and I multiply it by 5, we're going to do a multiplier of 5. That's a pretty conservative number. You're going to get then your pre-money valuation. Now the money that you're requesting is going to be the total of all your negative numbers here. So then your request funding is going to take all your negative amounts added up until you go positive. So this one is pretty simple because you have an 875 loss, a 350 loss, a 325 loss. You might have other losses in here. So you always want to make sure you have enough cash to stay afloat as a business. And so that's the funding you're requesting up front. So in this case, you take all your negative cash flow that you have in year 1, you add it up, you get a total, and then you have your post-money valuation. So then you take the dollar amount of what your need for negative cash flow and you divide it by the pre-money valuation. That gives you the percent that you're giving for that dollar amount. So when we watch Shark Tank and they're saying, okay, we're looking for $200,000 for 20% of the company, that means that their pre-money valuation is $1 million. And so then you take $1 million and you divide it by 5, let's say. Then they're saying, okay, that's how much income that the company's pulling off for the first 3 years. And so that's why when you watch Shark Tank and they're always arguing about valuation and they have no sales to show, that they're overvaluing their company. All right, so that is kind of what you're doing. This is not a perfect science. It is something that if you go in with a strong pitch, a strong MVP, you have good sales figures that you could show, so forth and so on, you could convince investors of the value that you're giving to them. But most investors, they want to know when they're going to get their money back, and so that could also come into the equation as you kind of present out. So that takes us to the end of the pitch then. So we went through, in 15 minutes here, I went through your startup SG&A cost of goods sold, how to create that first year, then take it to 3 years, and then how do you calculate valuation. So then at the end of your, once you go through all that, you're going to conclude your presentation. All right, email me if you have any questions, and good luck with everything, and let me know how it goes. Thank you.